Billionaire investor Jeremy Grantham just issued one of his biggest warnings yet, calling this the most expensive market in history and predicting that stocks could eventually face a massive decline of as much as 70%. In a new interview on CNBC, the legendary GMO co-founder discussed the state of the economy, the stock market bubble, the AI boom, and why he believes investors should be extremely cautious right now. First, I'll play you the clip of Jeremy Grantham's interview, then I'll give you my detailed reaction and break down exactly what he means for investors today. And finally, I'll share my in-depth analysis of 3 surefire stocks that I believe are worth buying right now. Let's hear what Jeremy Grantham has to say.
Our next market guest is a legend. He's got a long history of calling bubbles, and I think you're worried about all that grease, maybe. We'll see. Jeremy Grantham is here. He's the co-founder and long-term investment strategist of GMO, an asset management firm with $85 billion in assets under management. And he is the author of Making of a Perma-Bear, The Perils of Long-Term Investing in a Short-Term World. And we're thrilled to have you at the table this morning. Good morning.
Be here.
So we're cooking with gas, apparently, or with grease. And the question is, are we in a bubble? Are we not in a bubble? Are we always in a bubble? And how much of this is about being able to call the timing versus being able to actually understand the underlying economics at play?
Okay. We needed a definition of a bubble, so we found a very precise one, a nerdy statistical term, 2 sigma, the kind that would come up every 44 years if it was completely random, and actually it comes up every 36 years, so it's pretty close. And we tracked through and found all the bubbles that met that definition, and we asked the question, how many broke all the way back to the pre-existing trend, and there were 26 of them, and 26 broke all the way back to the pre-existing trend. And some of them went up from 2 sigma to 2.5 sigma, and in the case of Japan, almost 3 sigma. So they can be painfully higher than just 2 sigma. And that's the problem, because the client's patience is not quite as long.
So I appreciate the problem of calling it, but the other problem is that it has paid shockingly well to be a perma-bull over the last 100 years, more than it has paid to be a perma-bear.
Oh, of course. We live in a rising economy in the long run. But half the time you're waiting to get back to the old high. People don't realize that because we've just spent the last, whatever it is, 16 years going up. But in the long run, it's half the time. After 1929, you have to wait until 1954. After 1972, you have to wait until 80 a long time.
81 or 82.
81 or 82.
Yeah.
And so where are we now then? What's the comparable to you?
In a very real sense, I'm not sure there is a comparable, but the tech bubble of 2000 would come the closest. On the ways that are the value systems that are most predictive, based on the value of the stock market compared to the GDP with modifications. This is the most expensive market in American history.
And if it's the most expensive market in American history, does that mean that it's overvalued and has to go down from here? Or is it possible that it could continue to go up for many more years?
My guess is sometime between 2 weeks ago, 2 weeks from now, 2 months, 2 quarters, and conceivably 2 years. The timing is always terribly uncertain. The market's going to peak out and drop back to trend. And getting back to trend from here is closer to a 70% decline than a 50% decline.
A 70% decline, you think, is in order?
Yes, I do. And bear in mind, we said a 75% decline for the NASDAQ in 2000 in our quarterly letters, and it went down 82.
What was in 2021 and 2022, what was your super bubble call? And that predicted an imminent catastrophe, crash across stocks, bonds, real estate, commodities, and stocks. And you had another one in 2023, another collapse prediction.
No.
But how about in
2021 was a
super
one
bubble?
Of the only 2 times I clearly said it's now. The other times I said it's overpriced. The 21st century has been overpriced by the standards of the 20th century. 100 years of data,
Right.
we've been overpriced.
But is there any argument around, I was going to make an argument around technology.
Or 2010, but through
2021
the
was,
2010s, were you ever bullish through that entire period?
2009, almost there. I posted my only one-pager called Reinvesting When Terrified.
But most of the time,
by a miracle,
but it was a big bull market,
bottom,
2010 to 2020.
666.
Okay.
And nobody else, by the way, was touting the market that week, that month.
But through 2010, a huge bull market to 210 to 220.
From 2010 until today, the PE has averaged over 60% higher than it did for the prior 100 years. Now, I don't know when you decide to say the market is overvalued, but if you're traveling at 60% higher PE than it used to be, I think that it doesn't say the market's going to collapse, but it does indicate it's expensive.
Well, that was my question. This goes to the technology piece of it, and I think we're at this moment now with AI where everybody's, asking the question, which is, the most dangerous words in economics: is this time different? You talk about a 60 times PE. Are we in a situation?
No, 60% higher.
60% higher PE. Are we in a moment now, though, where the technology fundamentally is different, and it fundamentally is going to rewrite the rules of investing and valuations and everything else?
The great new inventions, railroads, are always accompanied by it's going to rewrite the rules. Internet, a huge invention, changed everybody's life. They were always accompanied by overinvestment and temporary collapse, out of which the railroads changed the world, the internet changes the world. This is exactly the case today. AI is so obviously a dazzlingly important idea. Everybody knows it, don't they?
Yep.
We all know it, and therefore we all want to put our money in it, don't we? Mm-hmm. So we all put our money in it, and it sucks in more than you can shake a stick at, and you get overinvestment. So everyone, in the end, in those situations, loses their shirt. They lost their shirts in the railroad. Brilliant idea. They lost their shirts in the internet. These are the three great ideas of the last 200 years. And they will lose their shirts in the AI. Now, out of that, bear in mind that Amazon in 2000 came down 92%. It had gone up 6 times. It came down 92%, and then inherited the earth.
Well, so what I was going to ask is, I'd asked Jeff Bezos about whether we were in a bubble when I saw him and interviewed him on this broadcast just a couple of weeks, maybe a month ago now, and he said we might be in a bubble, but actually that bubbles unto themselves, when you think about sort of great innovation and great progress, even for humanity, is required.
Think of the fiber optic cable that got laid. It ruined everyone at the time back in 2000. But eventually we used all that cable. The trouble is, by the way, that fiber optic cable would last a long time. Chips today may be redundant in 2 years.
So you think there's actually a big distinction?
I do.
Between some of the investments that were made then. And, we were talking, when I was talking to Jeff, it was about biotechnology, and actually a lot of stuff that actually, there's that biotech bubble, but a lot of great things came out of it. You think less great things are ultimately going to come out of this sort of data center
I think
build-out?
This is going to change everyone's life. The disagreement in opinion is more profound than I've seen in anything in the stock market ever, really. The Nobel Prize winners disagree. The bosses disagree. The worker bees disagree. Everyone disagrees about the consequences. We're either going to be sitting on the beach getting served mint juleps by machines, or they're going to kill us, accidentally or on purpose.
One of the first things that stood out to me in this interview is that Grantham does not throw around the word bubble casually. He actually uses a statistical framework to define one. He talks about markets reaching what he calls a 2 sigma event, meaning valuations have moved so far from normal levels that such an occurrence should theoretically happen only once every several decades. That is important because he is not saying that every expensive market is a bubble. He is saying there are rare periods in history where prices become detached from historical norms to such an extent that investors begin behaving differently. They become convinced that the old rules no longer apply. And according to Grantham, every single bubble that met his criteria eventually crashed back to its long-term trend. That is a powerful statement because it is built on decades of market history. He is essentially saying that no matter how exciting the story is, no matter how revolutionary the technology may be, valuations eventually matter again. I think this is one of the biggest lessons investors need to remember in today's market. We often hear phrases like, "this time is different," or "the old valuation models don't work anymore." History shows that those statements are usually made near the peak of major bubbles, but then the interviewer pushes back and raises a very fair point. If you had simply stayed bullish throughout American history, you would have made an enormous amount of money. And honestly, this is where the debate becomes fascinating, because both sides are right. America has been one of the greatest wealth-creating machines in history. Over long periods of time, simply owning stocks has been an incredibly rewarding strategy. However, Grantham reminds us that there have also been long periods where investors waited years, even decades, just to recover their losses. He points to the crash of 1929. Investors had to wait until the 1950s before fully recovering. He references the bear market of the 1970s, where it took years to get back to previous highs. This is something that younger investors especially need to understand. The last 16 years have conditioned many people to believe that every dip is temporary and every decline is an opportunity to buy immediately. But history tells us there are periods where markets can remain dead money for a very long time. Personally, I think this is one of the dangers of recency bias. We assume the future will look like the recent past because that is all many investors have experienced. Then comes the moment that grabbed everyone's attention. Grantham says that on his preferred valuation measures, this is the most expensive market in American history. Think about that statement for a second. Not more expensive than the dot-com bubble, not more expensive than the roaring 20s. According to him, this is the most expensive market ever. That does not automatically mean a crash is coming tomorrow. Expensive markets can remain expensive for longer than anyone expects. But it does mean future returns could be significantly lower than investors are assuming. And then Grantham drops his most shocking prediction. He believes that eventually the market could decline by nearly 70% from its peak to return to historical trend levels. A 70% decline. That is the kind of prediction that makes headlines because it sounds almost unthinkable in today's environment. Now, do I personally think a 70% crash is inevitable? No, I do not. I think predicting exact market declines is incredibly difficult because the market today is very different from previous decades. Corporate profitability is higher, technology companies dominate the economy, and central banks have repeatedly shown a willingness to intervene during crises. But I also think investors make a mistake when they immediately dismiss people like Grantham simply because their forecasts sound extreme. Remember, he was one of the few major investors who warned about the dot-com bubble and the housing bubble before they burst. That does not make him infallible, but it does mean his concerns deserve serious consideration. The conversation then shifts to perhaps the biggest story in investing right now, artificial intelligence. And this is where Grantham's perspective becomes really interesting. He fully acknowledges that AI is revolutionary. He does not deny its importance. In fact, he puts AI in the same category as the railroads and the internet, calling them the three great transformative innovations of the last 200 years. That is a huge statement. But then he makes an equally important point. Every great innovation in history has also created massive overinvestment. The railroads changed the world. The internet changed the world. Yet investors still lost fortunes during those booms. This is such an important distinction because people often confuse technological success with investment success. The two are not always the same. A technology can completely transform humanity and still produce terrible investment returns if investors overpay for it. The dot-com era is a perfect example. The internet absolutely changed the world. The bullish thesis was correct. The timing and valuations were wrong. Many investors who bought at the peak still suffered catastrophic losses. Grantham believes the same thing could happen with AI. He is not saying AI is a fad. He is saying investors may have become too optimistic about how quickly profits will arrive and how much growth has already been priced into stocks. I actually think there is a lot of wisdom in that argument. Sometimes the market correctly identifies the next big thing but incorrectly prices it. There is a huge difference between saying AI will change the world and saying every AI stock is a great investment at today's valuation. Those are two completely different statements. Grantham even brings up one of the greatest examples in market history, Amazon. The company eventually became one of the most valuable businesses on the planet. But during the dot-com crash, its stock plunged 92%. Imagine that. A world-changing company, an incredible business, a massive long-term winner, and yet investors still endured a 92% collapse. That example alone should remind investors that even great companies can become terrible investments if purchased at irrational prices. Another point that caught my attention was when the interviewer brought up Jeff Bezos' argument that bubbles can actually produce positive outcomes because they encourage enormous investment in new technologies and infrastructure. I think there is a lot of truth to that. The internet boom led to huge investments in fiber optic networks. Many companies went bankrupt, but society ultimately benefited from the infrastructure that was built. In many ways, bubbles can accelerate innovation. However, Grantham offers a warning. He says today's AI investments may be even riskier because technology evolves so quickly. The chips being purchased today could become obsolete within a few years. That is a fascinating point. Data centers costing billions of dollars today may need significant upgrades much sooner than investors expect. The speed of technological change creates additional uncertainty. Toward the end of the interview, Grantham says something I found incredibly interesting. He says the disagreement surrounding AI is deeper than anything he has seen in the stock market. Nobel Prize winners disagree, corporate leaders disagree, researchers disagree. Nobody truly knows how this story ends, and I think that is probably the most honest assessment anyone can make right now. AI could generate productivity gains that reshape the global economy. It could create entirely new industries. It could also disappoint investors in the short term if expectations become too unrealistic. That uncertainty is exactly why markets remain so difficult to predict. If everyone knew precisely how AI would change the world and exactly which companies would win, there would be no investment opportunity. So what is the biggest takeaway from Jeremy Grantham's interview? For me, it comes down to one simple idea. Great innovations and great investments are not always the same thing. The stock market has a habit of getting overly excited about transformative technologies, bidding prices to extraordinary levels, and then eventually correcting when expectations outrun reality. That does not mean investors should avoid AI. It does not mean a 70% crash is guaranteed, but it does mean investors should be careful not to confuse excitement with value. Jeremy Grantham may end up being wrong on the timing once again. He openly admits that timing bubbles is nearly impossible. But if history teaches us anything, it is that valuations eventually matter. And perhaps the most valuable lesson from this entire interview is this. You can believe in the future of artificial intelligence while still being cautious about how much you are willing to pay for that future today. Now let me break down the 3 powerful stocks with deep competitive moats, long-duration growth drivers, and strong long-term relevance across healthcare, global commerce, and digital payments that people depend on whether the market is booming or collapsing. The next stock is HCA Healthcare, ticker symbol HCA. This is one of the largest hospital operators in the United States, and it plays a critical role in the healthcare system that most people only think about when they need urgent care or major medical treatment. But from an investor standpoint, what matters is not just what the company does, but how defensible its position is inside one of the most structurally protected industries in the economy. And right now, HCA is going through a period where the market is looking at short-term pressure instead of long-term strength. The company performed well in recent years, but the story heading into 2026 looks very different. The stock has pulled back, and that decline is tied more to macroeconomic uncertainty than any breakdown in the business itself. Inflation is still elevated. Some economists continue to warn about a potential recession. And although geopolitical tensions have eased somewhat, there is still a lingering sense of instability in the broader economic environment. This type of backdrop tends to create hesitation in healthcare-related stocks, even when their long-term fundamentals remain intact. And that is exactly what is happening with HCA. But when you strip away the noise, 3 major strengths stand out. First, HCA Healthcare is a dominant leader in its niche, with a large and highly established network of hospitals and medical facilities across the United States. This is not a fragmented business. It is a scaled operator in an industry where scale matters significantly. The healthcare facility industry itself is protected by extremely high barriers to entry. You cannot simply build a competing hospital chain quickly. The upfront capital requirements are massive. The regulatory approval process is complex, and the operational expertise required is difficult to replicate. This creates a natural moat that protects incumbents like HCA. Second, even within that protected environment, HCA has continued to strengthen its position over time. It has steadily increased market share, not just by being large, but by being efficient and technologically advanced in its operations. The company has invested in improvements that make its facilities more attractive to patients and more efficient to run. In healthcare, small operational advantages can compound into long-term market share gains, and HCA has been consistently executing on that front. Third, and arguably most important for long-term investors, is the demographic tailwind. The global population is aging. That single trend drives structural demand for healthcare services over multiple decades. More hospital visits, more procedures, more chronic care management, and more demand for advanced medical infrastructure. This is not a cyclical trend tied to interest rates or economic cycles. It is a long-duration structural force. When you combine these three elements, dominant scale, high barriers to entry, and long-term demand growth, you get a business that is fundamentally resilient even in uncertain economic environments. Now here is where I think the market often misprices companies like HCA. When short-term pressures like inflation or recession fears appear, investors tend to assume demand will weaken permanently. But healthcare demand does not disappear in a downturn. In many cases, it remains stable or even increases. So what you often get is temporary sentiment weakness layered on top of long-term structural strength. That is the exact dynamic currently affecting HCA Healthcare. And that is why, despite short-term volatility, it continues to stand out as a long-term candidate for investors who are willing to look beyond immediate macro concerns. Now, before we move into the second company, it is worth zooming out for a moment. What we are seeing here is not just three individual stock stories. It is a broader theme of essential systems being temporarily discounted because of uncertainty in the market, and in many cases, that is where long-term opportunity begins to emerge. Now let's continue. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The next stock is MercadoLibre, ticker symbol MELI. If HCA Healthcare represents stability in the physical world economy, MercadoLibre represents the rapid expansion of the digital economy across one of the fastest growing regions on the planet. And what makes this company so interesting is that it is not just an e-commerce platform. It is building an entire ecosystem that combines online shopping, logistics, and financial services into a single integrated network. But right now, the market is not rewarding that vision. MercadoLibre has faced increased competition in the Latin American e-commerce space, and that competition has forced the company into a very deliberate strategy of heavy investment. Management has been aggressively reinvesting into long-term initiatives, even if that means lower profits and compressed margins in the short term, and naturally investors have reacted negatively to that. That is one of the key reasons the stock has underperformed broader equities over the past year. On the surface, it looks like slowing profitability, but underneath it is something very different. It is a company intentionally sacrificing short-term earnings to build long-term dominance. And to understand why that matters, you need to look at what MercadoLibre is actually trying to build. One of the biggest structural opportunities in its core markets is financial inclusion. A large portion of the population in Latin America is underbanked, meaning they do not have full access to traditional financial services like credit, savings, and digital payments. Most companies would see that as a limitation in the region. MercadoLibre sees it as an opening. The company has been aggressively expanding its financial services division, building tools that allow users to transact, borrow, save, and participate in digital commerce without relying on traditional banking systems. Now here is the key point. This does not immediately improve margins. In fact, it does the opposite. It increases costs in the short term. But over time, it creates a much deeper and more sticky ecosystem where users are not just shopping, but actively using MercadoLibre as their financial platform. That is a much more powerful position to be in. At the same time, the company is strengthening its core e-commerce business through strategic improvements. One of the most impactful changes has been lowering the threshold for free shipping on its platform. On the surface, that might seem like a small operational tweak, but in reality, it has a meaningful impact on user behavior. It encourages more frequent purchases, increases gross merchandise volume, and strengthens engagement across the platform. Even if margins are temporarily compressed, the long-term effect is ecosystem expansion. And then there is another layer that is becoming increasingly important: advertising. As MercadoLibre's platform grows, it is building out high-margin advertising opportunities that allow sellers to pay for visibility and better placement within the ecosystem. This is one of the most profitable layers in modern digital platforms once they reach scale. So what we are seeing is a multi-layer expansion strategy: e-commerce as the foundation, financial services as the growth engine, and advertising as the high-margin layer. When you look at it that way, the current sell-off starts to look less like a structural problem and more like a valuation reset driven by short-term profit concerns. And that is why many long-term investors believe the reaction has been overdone. Because while the market is focused on compressed margins today, the company is actively building multiple long-duration growth engines that could define its future profitability for years to come. Now at this point, it is important to step back and recognize a broader pattern across both companies discussed so far. HCA Healthcare is being discounted because of macro uncertainty. MercadoLibre is being discounted because of reinvestment pressure. In both cases, the underlying businesses remain strong, but sentiment is focused on the short term. And that brings us to one of the most important themes in investing. The gap between price and reality is often widest when uncertainty is highest. And that is exactly where opportunity tends to emerge. Before we continue to the final company, there is a sponsor message I want to share with you. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The next stock is Visa, ticker symbol V. If HCA Healthcare represents essential physical infrastructure and MercadoLibre represents the expansion of digital commerce in emerging markets, Visa represents something even more fundamental. It represents the global payment system that quietly powers almost every modern transaction. Every time money moves between a consumer and a business, Visa is often involved in the background, processing that transaction and taking a small fee for enabling the entire system to function smoothly. And that is exactly why this business is so powerful. It is not dependent on one product cycle, one market trend, or one region. It benefits from the overall growth of global commerce itself. But despite this structural strength, Visa has recently come under pressure from a different source entirely: regulation and legal risk. Visa is currently facing an antitrust lawsuit in the United States, and there is also proposed legislation aimed at challenging the dominance it shares with MasterCard in the global payments industry. These developments have introduced uncertainty into the narrative, and markets tend to react quickly when uncertainty increases. However, when you move away from headlines and focus on the core business mechanics, Visa's position remains extremely strong. At the heart of Visa's dominance is its network effect. This is what creates its moat. The value of Visa's network increases as more participants join it. The more consumers hold Visa cards, the more merchants accept them. The more merchants accept them, the more banks issue them. And the more banks issue them, the more entrenched the entire system becomes. It is a reinforcing loop that becomes stronger over time, not weaker. And importantly, this network is still expanding globally. One of the biggest long-term growth drivers for Visa is the continued transition away from cash and checks toward digital payments. In many developed economies, digital transactions are already dominant, but in many emerging markets, cash is still widely used. That represents a massive long-term conversion opportunity. Every shift from cash to digital payments expands Visa's addressable market. At the same time, global e-commerce continues to grow, and digital transactions are the default payment method for online purchases. This trend further reinforces Visa's position as a core layer in the financial system. So even though Visa is already a mature and highly profitable company, its growth story is far from over. Now, the concern investors often raise is whether regulation can disrupt this trajectory, and this is where historical context becomes important. Major antitrust cases in the United States do not always lead to structural breakups of dominant companies. In many cases, they result in operational adjustments rather than fundamental destruction of the business model. We have seen similar situations in other large technology and financial ecosystems where regulatory pressure increased, but the underlying network remained intact. Even if regulatory outcomes eventually force changes, Visa's infrastructure is so deeply embedded into global banking and commerce systems that replacing it would be extremely difficult. That embedded position is both its greatest strength and the reason it attracts regulatory scrutiny. Interestingly, despite these concerns, Visa's stock has actually lagged broader market performance over the past year, even while the company continues to deliver strong financial results. That disconnect between fundamentals and stock performance is important, because when a business continues to execute well but the stock underperforms due to fear, it often signals that much of the risk is already priced in. And in Visa's case, the combination of strong cash flows, global expansion potential, and network effects suggests that long-term compounding is still very much intact. So when you step back and look at all three companies together, a clear pattern emerges. HCA Healthcare operates inside a protected and essential healthcare system. MercadoLibre is building a multi-layered digital ecosystem across an emerging economy. Visa sits at the center of global financial transactions. Three different industries, three different growth drivers, but one shared characteristic. Each business is deeply embedded in a system that becomes more valuable over time. And that is what makes these types of companies so powerful for long-term investors. They are not dependent on short-term narratives. They grow through structural change. Now the question I want to leave you with is this. Which of these three companies do you believe has the strongest long-term compounding advantage and why? Is it healthcare infrastructure supported by aging demographics, digital commerce expanding across emerging markets, or a global payment network embedded into nearly every transaction worldwide? Share your thoughts in the comments. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.